Hello, founders. Welcome back. We are here for part 3 of quarterbacking your tax return. We are here with Stan Swartz, who is the president of Info Money Solutions, Inc. In case you're actually just tuning in, I definitely want you to go back and check out the first 2 episodes because Stan and I have been having a lot of fun. We've actually infused a lot of laughter and humor into the topic of taxes. So it is not dry and it is not boring. So go back and check it out. But here we are for part 3. And the whole idea of this segment is really understanding now how to prepare for our return here coming up. We're right in tax season. We can see the end line. The goal is in sight, and Stan's here to share with us some tips and tricks so that we are in a position to be better prepared come March. So, Stan, what do you have for us? Where do you want to start?
Okay, you're down at the 10-yard line. So number one, what you should realize or you must have is you must have a CRA My Account. So if you haven't got one, go onto the CRA website, register for a CRA My Account. They'll send you you'll set up a username and a temporary password, I believe, but they'll send you a password to use. I think they send those in the mail for security purposes. And then take a look at your CRA account. It'll give you your tax history of all your previous tax assessments. It'll see what installments you may have paid for the current year. It'll show you what refunds. It'll show you your tax-free savings account balances. Show you your RSP balances. And like I said, there's a wealth of information there, and it'll also give you access to prior years. T4s, T4As, T5 slips, T3 slips, and all that stuff. So it's a good way of checking to make sure you've got all the slips to make sure before you give everything to the account.
Okay, that's brilliant. One question on that: is it showing us anything about the business or no? Just our personal.
No, that's personal. So you can get a separate CRA business account.
Okay.
Which will give you all your business accounts and the history as well. So having said and so on this My Account, whether you have the copies of your paper tax returns from prior years or not, it'll also give you the loss carry forwards that you have. So you may have had stock transactions in previous years that generated losses which haven't been carried back but are eligible to be carried forward. So if you've got capital gains in 2020, you may have some losses that you weren't aware of that you can use to offset gains. So that's number one, to be aware of those carry forward balances. The other thing to be aware of is certain things may have happened to you or a family member during 2020 that makes you eligible or them eligible for a disability tax credit. I've seen a lot of situations where clients, I had one where I hadn't seen the client in a number of years, and he showed up to the office and he came in walking with a cane. I said, what's wrong? He says, well, I got this problem and mobility issues and yada, yada, yada. So I said, well, we should probably apply for a disability tax credit for you. So he says, oh, what's that? So I explained it to him. We applied for the disability tax credit, carried it back, and you can go back 10 years to get that credit. He got a check for $14,000 from CRA.
Wow.
So if you've got a disability, if there's a family member that's possibly eligible for that disability tax credit, accountant may not ask what changes have happened in this past year that may make you eligible for credits that they are not aware of. Whether there's been new children in the family and things like that. So that's just one aside. Again, with RSPs. If you've made an RSP contribution, is 2020 the best year to take that deduction, possibly carry it forward to future years. If your income was low for whatever reason, maybe your business suffered because of the pandemic,
yeah,
and you didn't take out as much money from the business, had a reduced salary, don't utilize that. Don't utilize that RSP contribution. Carry it forward to when your income improves.
Wait, sorry, one second there, Stan. I just want to, let's just hammer home that point because it was a really important point, and I feel that some of the people listening might have glossed over that. So why Stan here is recommending that we don't put in those RRSPs, because when you contribute the RRSPs in that year, you're mitigating your tax dollars, right? You're mitigating the dollars that you need to pay because it's recognized as income. So if you're not making a huge income that year, and I think 2020, I think it's safe to say a lot of people struggled with income. That would not be the year to top up your RRSPs, because you're already going to be paying lower taxes if this is your specific situation, right? I wanted to really hammer that home for people.
If you make the contribution, look at the best place, look at when's the best time going to be to utilize it.
Beautiful.
Don't just, and most accountants, when faced with the RSP receipt, they just take the deductions. They're not saying, well, are things starting to turn around? Should we save this contribution? Now, so that's my recommendation there. And if you've got the excess cash for whatever reason you had it and you were planning on putting it into an RSP before March 2nd, maybe for the time being, put it into a tax-free savings account if you've got the room.
Okay. Can you please just clarify the difference for founders? I know for some of them it's going to be like, I already know this, but for others, what is the difference from a tax implication between an RRSP and a TSFA?
All right. Tax-free savings accounts, a great thing that the CRA government came up with a number of years ago, and allows you to put money into what they call a tax-free savings account, and invest that money into a number of different things. So whether it be stocks, bonds, mutual funds, savings accounts, whatever income is derived from that investment within the tax-free savings account is not subject to tax. Zero tax. You're putting in tax-paid dollars, so there's no deduction on your tax return for it, but whatever income it earns is not going to be subject to tax.
Beautiful.
With an RRSP, you're putting in dollars that you paid tax on generally, but you get a refund of those tax dollars because you made the tax Rrsp contribution. So what happens is that money goes in, it earns whatever income it earns, whether it be tax, capital gains, dividends, interest. While it's in the RSP, you're not paying tax on the earnings. When you pull it out, at whatever age you decide to start pulling it out as in the form of a RIF or just withdrawal from the RSP, you're going to be paying tax on those total dollars that come out. So it's not just the earnings that RSP money made, you're paying tax on all the money that comes out. Now, if we got time for an aside on that?
Let's do it. Absolutely.
I wrestle with this with a lot of clients, whether or not to actually be making RSP contributions. Because when the money comes out of an RSP, generally in the form of a RIF, you're paying full taxes on the total amount that comes out. So whether it be tax, whether it be capital gains, whether it be dividends, whether it be interest, you're going to pay full taxes on it. If you make the contribution within a tax-free savings account, you're not paying any taxes on whatever comes out. But again, you're putting in after-tax dollars. If you put that money into a non-registered account, not an RSP, not a TFSA, when you earn capital gains, you're only paying tax on half the gain. If you're pulling it out in the form of dividends, you're only going to pay tax at about 32 or 34% on those dividends. But if you're in a high tax bracket, if the dividends were earned within an RRSP, you could end up paying taxes at a 52 or 54%. So in some cases, what I say is you've got to take a good hard look at where you're putting the money. Sometimes it doesn't pay to put the money into an RSP, even though you're going to get that deferral, and even though it's going to continue to generate or compound on a tax-deferred basis. Depending on the kind of investor you are and what ultimately your income could be, it may be a good idea not to always jump into an RSP. Now, I don't know if that's clear.
Yeah, no, well, there was a lot there, but what I'm hearing is like, you have to do the math, or you get the financial planner to do the math. To your point of the different scenarios. Option A, you do this is the consequence. Option B, or the outcome, right? Option B, option C. So the planner's laying it out for you.
Right. Now, as well, if you're over 65 and you're collecting old age security, if you're if you're receiving dividends, even from your own business, those dividends are grossed up for tax purposes. And those could increase the potential to have a clawback of your old age security, either part of it or all of it. So you have to look at that dividend income that's coming out of a non-registered account, or even when you start drawing out your RRSP money and saying, is this going to impact my old age security? So again, you have to do this. You have to look forward, you have to look back, and you have to say, take all these elements together and say, what's going to be the overall impact, not only on my taxes, but on the other income income-based tax credits that I get.
Yeah. You know, and for anybody that's listening that is feeling like this might be a little overwhelming, right? Just again, remember, this is why you've got the players on the field. You've got the financial planner, the advisor, the accountant, and the lawyer. And I have to say, I have never felt more assured and more comfortable, and quite honestly, more financially secure when I have these people around me and they pay for themselves in the money that they actually save me or make me. If I had to do this on my own, I probably would have lost tens of thousands of dollars. So for those people who are like, oh my gosh, that's a lot of work, and oh my gosh, now I've got to hire someone to do all of this. The money that you invest in these people long term can save you tens, thousands of dollars, right?
Yeah.
As we
go
forward.
The worst surprise is when you get your tax return after the tax return's completed, and the accountant says, oh, by the way, your old age security was completely clawed back. And you say, well, what happened? You say, well, you took out an extra $20,000 of dividends from your corporation, and that impacted your old age security. And you say, well, I only took out 20,000, and I did a calculation that it wouldn't impact. You say, but it got grossed up. And that gross up on the dividends wiped out your old age security.
Okay.
Along with all your other income.
So
that's a lot to deal with.
It's a lot to deal with. So as we move into taxes, sorry, that scenario you gave me, it reminded me of another episode we did where we were talking about amortization on equipment and how many accountants just write it off in whatever way they feel they need to write it off without understanding the long-term consequences, right? And how it impacts the valuation of the business. And then a lot of founders are saying, well, how do we know? How do we know these things? So what do you think? And I don't want to put a number to this, but when we are preparing for our taxes, what are the questions? What are the top questions? And this might be a loaded question because I think it depends on if you're a business owner and how old you are, but what are the top 3 to 5 areas that we want feedback on, or the questions that we want to present our accountants so that we know what they're doing and why they're doing it?
Well, I think the first question is to challenge them and say, what could I have done differently to reduce my taxes? Now, if the only thing you've got is a T4 slip, there ain't much. Okay. But then if you're a business owner and the interrelationship of the business and yourself, they should be able to answer that. It's an open-ended question.
Yeah.
But they should be able, but if they can't answer that question and say, we could have done this and we could have done that, but say, okay, fine. So the books are closed on 2020. Well, what can we do in 2021? And possibly, not very often, but sometimes you can do a little bit of retroactive planning. And like you just touched on with the depreciation and amortization and capital cost allowances, in some cases, it may be on the personal side. People have investment property. And in a lot of cases, the accountants automatically take capital cost allowance on the building value of that property, not on the land, but on the value of the building on the property. I would never do that. I would have a good conversation with my client and say, let's not take the capital cost allowance, unless it's a really significant number, on this property for 2 reasons. Number one is the tax saving is going to be insignificant. But the bigger one is if, as and when you dispose of the property, by whatever means that is, all that previous capital cost allowance is going to come back in and be treated as income. So you may have 20 or 25 years worth of capital cost allowance that all comes back in one shot and is taxed at regular income. So your tax saving might have been minuscule over the years because you may have been at a lower tax rate, but now you're going to have this huge amount of capital cost allowance that's recaptured on the disposition of that property, which throws up a big tax bill.
Wow.
So
Okay.
I would many times I'd say to the client, unless you tell me otherwise, I'm not taking capital cost allowance on this investment property.
Okay, so this is another great reason to have all the players on the team at the same time and quarterbacked by the financial planner so that they can see past, present, future, and how everything needs to align. One question for those of the audience that don't necessarily have their team in place, when they open up the Cra My Account, and thank you for that tip, I think that's a brilliant one. Does it actually show the different tax advantages or different policies that have come into effect for that year that will kind of at least allow us to go, oh, this is a new incentive, or this is a new incentive, or this is a new incentive, to give us something to go to the financial planner or the accountant with?
That's in a separate area of the CRA
Okay.
website. Now,
Gotcha.
you've touched on something very significant there. Spend some time going through the CRA website. You know, it'll tell you what the changes were for 2020, tell you what the changes are for 2021. You're going to have to be aware of the SRP benefits that you may have received in 2020 and how they're going to affect your taxes. Are you going to have to repay any of that? Have you gotten caught in whatever situation that you were unaware of? And coming back to the accountant, speak to the accountant. Did they take advantage or recommend to you, especially on the business side, to how to take advantage of whatever benefits you could have or should have?
Yeah, I think it'll be interesting, you know, at the end of the year, knowing that a lot of business owners received subsidies and received benefits, and put holds on leases, right? So yes, lower income, but also lower expenses, I think, for a lot of them. And so it's going to be definitely an interesting year, to say the least, to see what comes out in the wash.
And if you got the wage subsidy and you end up making more money than you otherwise thought, those wages that you've got a reduced salary cost, but higher profit, which you're going to be paying tax on.
Yeah. Okay. So again, get the players on the field so we know what's going on here. So all that leading up to taxes. Any recommendations now that it gets filed and we're waiting 3 months, 4 months after year end to get our return in and we actually see what we owe? Any suggestions on post game, our reflections, and anything we should be speaking to our players about?
Sit down with the players and say, okay, now if you didn't have time to review the tax return when it was completed, sit down and go through it with the accountant and say, okay, explain to me. Go through it line by line when they've got the time, and say, explain it to me. What went on here? What was the interconnection and the interplay of various lines on the tax return? Sit and then speak to your financial advisor and say, you know what if we converted some of these interest earning investments into dividend paying investments? What if because I don't need the income from the dividend paying stocks, should we be repositioning it into different equities that have greater growth opportunity? And then you can look at forward tax planning or succession and transition planning, and saying how's best to secure these investments in the event of a market crash or death or whatever, and avoid probate fees. There are ways of doing that, but that's for topic for another day. So you want to look at the tax efficiency of whatever it is you're invested in and how it aligns with your risk tolerance.
Okay. I personally really, that tip really resonates with me, because I think that, at the end of the end of every event I would do back in my business development days, as tired as we all were and as exhausted as we all were, we really sat down and went through a debrief right in that moment, because that's when it's fresh of mind for you, right? What did work? What didn't work? What would we have done differently? What can we do better next time? Because guaranteed, if you leave it, which a lot of founders do, until January, February of 2022, you're going to be like, what were we thinking about? We were thinking that there were some great ideas that we could be doing back then, but completely forgot about it. So
And us,
in the moment.
and us as taxpayers, go on that CRA website, see what things apply to you, read the financial papers, look in the newspaper, watch shows like this, get the tips, listen to them, and challenge the people that work for you.
Oh, that is huge. That is such a empowering place to leave it. Challenge, they work for you, right? You are paying them. So challenge them. I love that. You take ownership. And that other piece there, Stan, that I think really hopefully will sit with people. This doesn't need to be figured out overnight, but you take small, consistent steps. To your point, Stan, read something, watch the episode, speak to friends about it, look at your social media feeds, just inquire, curiosity, right? And small step after small step, you get better and better and better and stronger and stronger and stronger. And at the same time, building your team and asking them questions and learning from them. So do not abdicate, delegate, know the team, get out there and win the game. Stan, thank you so, so much. So appreciate your time and your insights, your intel. It's brilliant. I had so much fun with you here today. I know the founders that are listening in, I hope they had fun too. You want to say something. What do you want to say, sir?
Yeah, one final thought. It may not apply right now, but one of my partners always would say, no one who ever went to a cocktail party paid taxes.
But no one who ever went to a All right, there's another soundbite for you to end it off.
Right.
I love it. Thank you, sir. Again, just a shout out to our episode champion, Community Futures of Saskatchewan. Thank you for all that you do. You're there on the front line working with business owners to see their way through this pandemic. So thank you for that. And this episode, Stan, just so you know, we're turning it into a podcast. We've crossed the line and people can listen in. So thanks for being here. Download the tools. There's a checklist that you can download for this segment. We'll see you next time back in the Gab Lab for episode 7. Stan, thank you again, sir. Great to have you here. We'll see you soon. Stay well. Stay safe.
You too.
Bye for now.
Bye.